Good afternoon, and welcome to the StandBonNest Wednesday webinar series, Tax Planning Strategies for Architects, R&D Tax Credit, and the 179D Energy Tax Deduction. These monthly webinars cover a wide range of topics, including strategic tax planning, human resources, and project management, and are based on StandBonNest's experience serving over 850 professional service and AE firms. My name is Olivia Perry, and I'm the Manager of Communications and Member Relationships here at AIA Pennsylvania. On behalf of AIA Pennsylvania, I would like to take a moment to thank StandBonNest for their partnership supporting our events and creating member value with these webinars and the new Ask a Business Advisor corner featured in our newsletters. Related to today's webinar topic, we would like to congratulate StandBonNest as they just announced the formation of a state and local tax practice to untangle the increasingly complicated web of tax laws faced by companies doing business in multiple states. And just a few webinar tips and tricks before we begin. If you are having difficulty hearing this webinar, please select the Raise Your Hand button found in the control panel to the right of your screen. And please feel free to direct your questions to the questions box in the control panel as the webinar progresses. We will be answering them during the Q&A session at the end of the webinar. Additionally, please be sure to complete the survey that will pop up immediately following this webinar and in the follow-up email so we can record your member number for credit. I want to take a moment to introduce you to today's webinar presenter, Tom Mao. Tom is the Director of Strategic Tax Advisory at StandBonNest. Tom specializes in customized planning that increases tax efficiency by considering the unique big picture needs and goals of each client. Working closely with companies, Tom outlines steps to minimize taxes, identify alternatives, and understand tax implications and structure transactions. Additionally, Tom applies his tax expertise to clients who are conducting or considering conducting international business ventures. So, without further ado, I'll hand it over to Tom.
Well, thank you, Olivia, and good afternoon, everyone. Thank you for joining us today. Before we do get started, I just wanted to mention we do have a couple of poll questions that will come up throughout the presentation today. We would appreciate if you would just take a second to answer those polls as they come up, because they give us a good feel for everyone's knowledge level and which of these tax strategies they may or may not have taken advantage of yet, and helps us guide as to the information we'll provide today. As you see on your screen, our agenda today, in addition to the research and development tax credit and Section 179D energy deduction that Olivia mentioned, we are going to touch on briefly a few other tax planning strategies as well that may come into play to be helpful either to you within your firm or in some cases provide information to your professionals that they can pass on to their clients and prospects that hopefully will be beneficial to you and maybe help you win a little bit of business in the process. So we're certainly not going to try today to make you experts and get into a lot of technical talk on any of these tax planning strategies. Our goal today is more to provide awareness, to know that these things are out there so that you can recognize opportunities and that we can turn the table on taxes and save you some dollars. So with that, let's go ahead and get started. Before we get into anything specific, I just wanted to mention that there's an awful lot of talk, and I'm sure you've all heard it, about tax reform. And we're all pretty sure tax reform is coming. We just don't know when, and we just don't know exactly what it's going to look like. But one thing we're fairly certain of is that tax rates are going to decline in the future. So that makes these tax planning strategies maybe of even a little bit more urgency. We can still take advantage of them, possibly even for 2016 if you haven't filed your tax returns yet, if they're under extension for 2016, or even if you have, there may be the ability to do some amendments and take advantage of some savings, or possibly in 2017. As we worked through 2016, in June of 2016, the House Ways and Means Committee issued what was called their blueprint for tax reform, which had a lot of very aggressive tax planning strategies included with it. We also heard a lot of similar and related strategies coming from the Trump campaign and after election from the Trump presidency. Initially, it looked like maybe a lot of these provisions would be put into play during 2017, but as we are now almost halfway through 2017 already, which seems kind of hard to believe, but we are, we're now thinking that it may be more than likely that we won't see some of these items go into place until 2018. So while we certainly look forward to tax reform, we certainly look forward to taxpayer-friendly provisions, we can certainly take advantage of some of the things that are already out there to save some dollars in 2017 as well as 2016. So with that, let's start looking at some of the specific items. So the first one we'll talk about is the research and development tax credit. And just to get a feel for how many of you have already looked at the R&D credit or at least have some knowledge of that, we're at our first poll question, and that is simply, has your firm taken advantage of the R&D credits? So as the poll comes up on your screen, if you would answer that, we would appreciate that. And once the results are in here in a second, we'll give those back to you.
$95 no and 5 yes.
Okay, so 95% of you have not taken advantage or considered the credit. 5% had. So that's quite all right, because that's our goal today, is to provide you with some education on the credit and see if maybe it is something that would work out for your firm. So let's get right to the bottom line and say, well, what is this credit worth to me? Well, in very general terms, and please don't hold us to this percentage, but typically the credit will be worth about 5 to 6.5% of something called qualified research expenditures, or QREs, and I'm going to explain what they are in just a minute. This can be a powerful tax savings opportunity because, remember, it is a credit, and credits offset taxes dollar for dollar. So $1 of credit reduces your tax bill by $1, whereas a deduction is going to be applied at your effective tax rate. So if you're in the 30% tax bracket and generate $1 of deduction, you're going to save 30 cents in taxes. So as we look forward and we anticipate tax reform, the research and development tax credit is likely to hold its value, because regardless of the tax rates, it will still offset taxes dollar for dollar, whereas the deduction diminishes in value because your effective tax rate goes down. We're certainly not going to ignore deductions, and some of the items we'll talk about today are deductions, but we really think a credit is the most powerful tax savings tool that you can take a look at. Some other good information to know about the R&D credit is it's now a permanent part of the tax code. The R&D credit has been around since the early 80s, but it has changed in form many times over those years and actually become much more broader based. In the early years, it was pretty tough to qualify for the credit. It got a lot of scrutiny from the IRS. It was known as a Tier 1 tax item, which meant if you took the R&D credit, you were almost assured to have it questioned, and you would have to justify to the IRS. Well, that's no longer the case. There's been many tax court cases that were very favorable to the taxpayer, that have broadened the scope and the applicability of the credit. And we now think that just about any design firm, an architectural firm or an engineering firm that is project-based, which I'm sure you all are, probably has at least some element, if not a very significant element, of their activity that's going to qualify for the credit. As I said, the credit is now permanent. That came about in late 2015 with the Protecting Americans from Tax Hike Act. So again, if we invest the time to set up systems to capture these qualifying costs, we know that's not going to be short-lived, that the credit is here to stay. In fact, just about 2 weeks ago, there was a provision in Congress to even enhance the credit even further, to increase the percentage of the credit and to broaden it to even more companies. So with that being the case, if you considered the credit a few years ago and maybe passed on it, I would really recommend taking another look at it because the credit has changed. The other change that was very significant in late 2015 was the elimination of a limitation on using the credit if you were subject to the alternative minimum tax. Now, we're certainly not going to try to get into any explanation of how the alternative minimum tax works. That could be a webinar in and of itself and probably not a very exciting one. But I think most of you recognize that more and more U.S. taxpayers have been subject to this alternative minimum tax over the years. If you are, if your entity is a pass-through entity, a partnership, or an S corporation, where the taxable income passes out to your owners and they pay tax at the individual level, even if the entity generated a nice credit and it passed through to your owner, if the owner was subject to the alternative minimum tax, they were precluded from using the credit. So that obviously turned a lot of people off and said, well, it's just not worth our time to look into this. Again, beginning January 1, 2016, the alternative minimum tax limitation no longer exists if the credit was generated by a firm who has average gross receipts of $50 million or less per year. So I'm guessing that probably covers most of our audience today. So if you looked at it before and said, oh, I can generate the credit, but I can't use it, again, time to take another look. And we have seen just a flurry of activity over the last year, especially this last tax filing season here in early 2017, of firms being able to take the credit. And we have some nice stories on that, even very small firms. We worked with an architectural firm that had about $3 million in annual gross receipts, and they were able to generate a credit of about $30,000. Pretty powerful tax savings. Even if you are a very new firm, a startup defined as being in your first 5 years of operation and having gross receipts on average of $5 million or less, you may not have hit a lot of significant profitability or taxable income yet. In that case, the credit can actually be used to offset your payroll tax expense, you know, one of those burdens that we all run into. And last but not least, if you still weren't able to use the credit, there is the ability to carry it back for a year and forward for 20 years. So hopefully that's enough to get your attention and say maybe we should take a look at this. So now let's take a look a little bit deeper of just what qualifies for this credit. Well, there's a four-part test to determine if your activity qualifies for the credit. And really, if you meet these four pieces, you will qualify. You don't have to be doing something revolutionary to the industry. If a competing firm, the firm right across the street from you, is already doing these techniques and you're just starting, that's okay. It really just is something that is new to your business. The four bullet points are the activity has to be technological in nature. Well, I think, which means it's based on the hard sciences. Well, I think most of the work in the architectural field is going to qualify for that. It's based on whether it's physics, chemistry, what have you, and concepts of engineering. That is going to qualify. The next two bullet points kind of go together. Involves the process of experimentation and eliminates uncertainty. When your client comes to you and says, I want you to design a new office building for me, you know you can do that, but you know there's going to be, in your schematic design or your design phase, some brainstorming, some trial and error, you know, as you look at different materials, different compositions, you know, soil samples, and all the other things that go into your decision of how you are going to construct this unique project, you're going to meet the criteria for experimentation and uncertainty. We like to think about, and it's been kind of upheld in tax court cases, that every project is different. Every project brings a different set of challenges and concerns that you're really putting that formula together that is going to make that project successful. The last bullet point is that the end result is a new or improved function, performance, reliability, or quality. Here again, I think there's been some misunderstanding of the credit. that some people have thought, well, the credit only applies if I'm coming up, again, with a new product to take to market. Maybe, you know, a miracle drug or something in the pharmaceutical industry. Well, certainly that qualifies, and certainly those type of firms have benefited greatly from this credit, but it's not necessarily a product. It can be a new process. It can be a new technique, a new way of doing things within your own firm. So as you institute new technologies to do things differently than you did them in the past, those activities, again, are going to qualify for the credit. So the next slide just, again, walks through a little bit of what a business component is and kind of reemphasizes that point that it's not necessarily just a product. Processes, software development, techniques, formulas, inventions are all going to qualify. So now that we've talked about what kind of an activity qualifies, and we give some specific examples here: new or improved designs, looking at alternatives, prototypes, development of new processes and techniques. Now let's talk about those costs that come into play. Well, typically in the design world, architects, engineers, the biggest component of the qualifying costs are simply your wages. We simply look to the W-2 wages of the people that are involved in the process. Typically by doing a sampling of some of your projects, understanding what role people are playing, we can make a determination of what percentage of their time is spent in qualifying activities. If you have someone making $100,000 per year and 60% of their time is spent in a qualifying activity, we have $60,000 of qualifying cost. And it's not just the person doing the direct design or the direct qualifying activity, it's those people that supervise them as well as those people that support them, maybe your admin team. So obviously we want to maximize the wages that we can justify qualifying for the credit. Two other pieces that do come into play, maybe not to the same degree typically for an AE firm, are supplies that are consumed in the process. You would usually see this a lot more in a manufacturing concern where there's raw materials and the like being consumed. But we do see it in the architecture world from time to time. Folks are using things like 3D printers and doing lots of reprographics. So any supplies, direct costs that we can identify that were part of doing the modeling can be added into the bucket of QREs, as well as sometimes what the code calls contracted research, but really is our subcontractor cost. Now, that brings me to a little bit of an aside that should be explained, that the code also says that the research has to be unfunded. Well, what the term unfunded means is you're not being paid for every minute of your time that is going into the project. So if you have a pure time and materials contract where everything that hits the timesheet is going to be paid by your customer is in essence taking the risk then, because they've in essence given you, you know, a blank sheet of paper, an open-ended contract to charge them whatever time you get into it. I think in the world today, those type of contracts are probably somewhat rare, that most of your contracts, I would suspect, are fixed fee, lump sum, or even if they are time and material, they have some kind of a cap on them, so that you're taking the risk of cost overruns and the like. As long as the contract does have that risk element to you, it is going to qualify. Now, as we look at our subcontractors, we have to look at the same thing, at the contract terms. Who's taking the risk? If your subcontractor is billing you on a pure T&M basis, then you're taking the risk because, you know, in essence, again, they have the unlimited checkbook. If they quoted a fixed fee to you, the subcontractor more than likely then has the ability to consider the credit. So we certainly, when we do a study, we're going to ask you about, we're going to look at your subcontractor arrangements, and if any of them qualify, we're going to include them as well. But as I said, at the end of the day, it's really your wages that lead to the credit. So once we have those costs accumulated, we go through the computation. The computation is based on the current year expenditures over a base year of the prior 3 years, but that base year is reduced by 50% of the cost incurred in those 3 years. And I know that's probably getting a little bit beyond the scope of what we're talking about today, getting into the nitty-gritty of the computation, but just know that even if your expenditures are consistent year over year, you're going to be able to generate that credit. And it's under that assumption of consistent expenditures that we come up with our estimate that the credit's going to be, say, 5 to 6.5% of your expenditures. So if you do the math, if we can allocate $300,000 of your wage expense to qualifying activities year over year, we're talking about a credit of approximately $20,000. If you do have your expenditures are on the upswing, if you're growing, if those expenditures are growing, that just based on the formula and how you calculate the credit will grow as well. So the 5 to 6.5% is really a conservative estimate. One of the things that we do when we do the studies is we just get some reports from you, and we're able to give you a pretty close estimate of a range of what the credit will be just by looking at the growth in your firm and the type of activities that you partake in. The credit still, while it's not as scrutinized nearly as heavily as it once was, it certainly is open to exam or question from the IRS or even from the states, because there are some state credits available too. So it is very important that your activities are well documented. Those of you with a good time and billing system, just timesheet descriptions, phases and tasks that you're tracking within the timesheet often can provide a very good basis for that. And even if you haven't been tracking that in the past, that's something that, with a little bit of education or understanding of what qualifies for the credit, we can start capturing those credits going forward. So that's a quick overview of the R&D credit. Again, it's much misunderstood, very much underutilized, but we really truly believe that every design firm should at least consider and take a look at the credit, because we think if you're not, you may be leaving some tax dollars on the table. So with that, we're going to move into a couple of other potential savings items. One of those being, as Olivia referred to in the introduction, something called the Section 179D deduction. Now again, we tax folks like to talk in code and a lot of language that we forget that not everybody knows what we're talking about. But Section 179D is merely the IRS code section that has initiated and authorized this deduction. This deduction is a reward for energy efficient construction. So at its basic level, the deduction goes to the building owner, so in essence, your client. However, where the big opportunity comes for the design firm, and usually the architect is at the forefront on this, is if you're doing governmental work, and that can be at the federal, state, or local level. It can be public schools and universities, municipal buildings, prisons, federal buildings, whatever that may be. Those folks obviously don't have a need for a tax deduction because they're not tax-paying entities. They have the ability to assign this deduction to the designer of record. There is a process that you would go through, asking them to sign an allocation letter, which would designate you as a design firm as the recipient of this deduction. This is, if you're doing that type of work, this is a huge, huge opportunity, because it is really a deduction that you earn without really expending any additional dollars than you already have or giving really anything up in return. So let's talk a little bit more about the mechanics of this, how it works, and what it's worth. And then I actually have a bit of bad news at the end, but I'll save that for the end because I think we can overcome it. The deduction can be up to $1.80 a square foot, and it falls into 3 equal categories. Those categories are the design of the building envelope itself, the HVAC and hot water systems, and the interior lighting systems. Each of those systems are evaluated independently of each other. They're compared to federal energy standards. We're currently using the 2007 ASHRAE standards. And if they reduce energy consumption by stated amounts, you will qualify for this deduction of up to 60 cents per square foot. So again, for the building owner, it's powerful. If that's your commercial customer, you certainly want to tell them about this opportunity. They'll thank you for that, but you're not going to get anything in return for that. It's in the public building where you really have that opportunity. So if you've completed projects in the last 3 years and you haven't taken advantage of this, and no one else has, there's still the ability to go back, ask that representative from the governmental unit to give you that allocation letter, and we can go back and have the study performed and recoup that deduction and generate some very significant tax savings. So how do we go about this? What's the study all about? The study is an engineering-based study. It has to be done by someone independent to the project, and there's many firms out there that provide these services. It has to be done in government-approved software, and there's a certain format that it has to be done in. As long as that's met, it's almost audit-proof from the IRS because it's met their specific requirements and how it's performed. Now, the bad news that I mentioned is this provision expired 12/31/16. So the project had to be completed and put in service by last December. Now, there's a lot of talk that this provision is going to be renewed, hopefully even renewed back to 1/1/17. So unfortunately, as of today, as we speak today, projects that are currently being completed will not qualify for the deduction. However, if, as I said, projects completed in 2014, 15, 16 that you designed for governmental agencies that no one has taken advantage of this deduction, that is a tax deduction that's out there awaiting for someone to capitalize on it. So again, one that we can certainly get into more detail on. If anyone has some questions, I'd be happy to answer questions if you just send them our way. So with that, we'll come to our next poll question, and it's simply how many of you out there have the possibility of taking advantage of Section 179D for prior projects that you maybe didn't consider in the past. So again, if you would just take a minute to give us a yes or no answer on that, we'll share those results.
All right, we're actually 50-50 right now.
Okay, with those of you that have responded so far, we're about 50% think that this may be an opportunity that you can take advantage of, and about 50% maybe aren't doing governmental work, or maybe you've already taken advantage of it. And if you have, I'm sure you can attest to the benefits. So, but for the other 50% of you, maybe something to take a look at, something that can bring some pretty nice tax savings to your companies. So there, we'll move into now a number of other provisions that, again, you may or may not be taking advantage of. Even if you are, hopefully we can give you a tip or two on how to get further utilization or further maximization of these items. The next one, again, we're going to talk code section 199, something called the Domestic Production Activities Deduction. This was a provision that was put in place in tax law as a result of the downturn in the economy after the 9/11 attacks back in 2001. This was put in place to spark our economy to keep for the most part, manufacturing work on U.S. soil, but there are provisions in this provision that allow design firms as well as construction firms to also take advantage of the deduction. And we sometimes find that those firms have kind of looked over this deduction, assuming it was just for manufacturers. So what's it all about? Well, it's pretty powerful. It's a 9% deduction, 9% of your qualified production income, which in many cases is just your taxable income. Nothing more you have to do to earn this deduction other than have qualified activities and be profitable. Again, it's much like the Section 179D deduction, that it doesn't require any additional expenditure on your part. It just takes understanding the rules and taking advantage of it. It is the second largest domestic corporate tax break we have, behind some of the accelerated depreciation rules, which we are going to talk about in a few minutes. It is available, as I said, to all type of entities who have qualified activities. And what are those qualified activities? Well, the very broad definition is the manufacture, production, growth, or extraction of personal property. I like to say it just means you're making something, you're generating something. And it specifically states that architects, engineers, and contractors' activities related to construction projects, and that could be buildings, highways, bridges, the like, will qualify. So even though you may not be the construction firm who's actually going out there and putting, hammer to nail, as long as you're involved in the design process, that will be a qualified activity. Now, if every project you have is a qualifying project, the calculation is very easy. It's just going to take your taxable income times 9%. For those of you that may have a mixed bag of activities, some that do qualify, some that do not, those activities that you have that may not be related to a construction project won't qualify. There are some planning opportunities. And it all comes down to how you allocate your cost. And there are several available methods on that. Again, it gets a little bit complex and we won't go deep into that. But just know that if you're not getting a deduction of the full 9% of your taxable income because you're having to split your gross receipts between qualifying and non-qualifying activities, it may make some sense to have your method of calculation reviewed to see if that calculation could be maximized to get you a greater deduction. There are some limitations on it, but the good news is, again, we always worry about the alternative minimum tax. This deduction is allowable for the alternative minimum tax as well as your ordinary taxes. You do have to beware sometimes when it moves over to your state tax returns, because there are quite a few states who do not allow the deduction. But quite honestly, we usually start our tax planning activities at the federal level, because the federal deduction or the federal taxes are typically much greater than the state taxes, so the deduction at the state level, or the loss of the deduction at the state level, is not as big of a deal as gaining the deduction at the federal level. So again, just a question to think about. If the 199 deduction is not showing up on your tax return, or if you have a question on how to identify that, we're happy to help. If it's not there, we're probably leaving a little bit of tax savings on the table. And as we said, I kind of got ahead of myself here with this slide, that there are certainly some very, very powerful tax planning strategies available to maximize the deduction. Next up, we're going to talk about really a group of strategies that all fall under what we call the fixed asset considerations. And most of these revolve around the construction of real property or the construction of a building. Now, these may only apply to your firm in that rare case that you are building a new office building or that you are renovating your office building. And for some of you, I'm sure that is applicable. The good news is on a number of these, we can go back many years, even beyond the 3 years that we can typically amend returns, to gather these deductions and bring them forward. But if they don't apply to you, I'm going to guess they would apply to your customers, those folks that you are helping to do design work for. So I think it's valuable to have a bit of a grasp on these concepts, because they could be a difference maker as you bid your work out, and can bring, you know, value-added thoughts to your customers. So we're going to do a progression here of a couple of items, which would include accelerated depreciation, something called cost segregation studies, what we term fixed asset reviews, and then circling back to the energy initiatives, but this time from the eyes of the building owner rather than the eyes of the design firm. And then we're going to try to tie that all together and show how you can aggregate these planning strategies to take the most advantage of them. So first up, we have the accelerated depreciation, and there's two methods of advancing your tax deductions under the accelerated depreciation. Typically, a piece of equipment, a piece of furniture, something that we put in service that has a useful life of longer than 1 year is required by IRS Internal Revenue Code to be depreciated over 5 years, 7 years, maybe even 15 years. Well, there is a provision under Internal Revenue Code Section 179, not to be confused with 179D, that says even though this piece of equipment typically would need to be depreciated over, say, 7 years, you can elect to expense all of it in year one, accelerate your tax deduction, get your tax savings today. It's a pretty generous provision right now. We can write off, as long as we have taxable income, we can write off up to $500,000 of purchases a year, as long as we're a smaller taxpayer who hasn't spent more than $2 million on qualifying expenditures in any given taxable year. In fact, the Tax Act that was put in place in late 2015 also made this provision permanent and indexes it for inflation, so that $500,000 will continue to grow over time. Now, for most of you, you're saying, well, geez, $500,000, I'm never going to put $500,000 worth of equipment in place in 1 year. Well, that is probably true, and, you know, from the positive aspect of that, it probably means, for the most part, everything you do put in service, we can write off immediately. So that's somewhat powerful. But as I said, as we work through these provisions, you'll see how these can work together and maximize the deduction. Section 179, as I said, is limited to taxable income, but it does apply to both new and used property that you would put in place. It just has to be in use by December 31st or the last day of your taxable year. A second provision under accelerated depreciation is something we call bonus depreciation. Again, bonus depreciation has been around since back in 2001, and bonus depreciation allows you to deduct 50% of the cost of new equipment in year one. So you may be thinking, well, why would I ever use that when I have Section 179 available to me and I can write off 100%? Well, that's probably a valid question, but if you're in a loss year and you can't use Section 179, you can actually use the bonus depreciation and maybe maximize your loss, because you may be able to take that loss back as a carryback and capture some prior taxes. Bonus depreciation is with us through 2019. We get a 50% deduction, and this is important for new property. We can't use it for used property, only new property. Out through the end of this year, the deduction reduces to 40% in 2018 and 30% in 2019. Like the Section 179, there's no alternative minimum tax adjustment, so we don't get called up in the AMT. And like the Section 179, we just have to have the property in service by the end of our tax year. So again, let's go back to our example and say, let's say we have a client, or even ourselves, that we put $1 million worth of qualifying property in place in year one. Well, we're going to take $500,000 of that as a Section 179 deduction. We've maximized that, but we still have $500,000 remaining that we that we otherwise would now have to depreciate over maybe 7 years. Well, we can apply the bonus depreciation to that $500,000. So now we've got $750,000 written off in year one, and then we still have $250,000 that we will depreciate over 7 years. So we get part of that in year one as well. So we've now gotten a tax deduction for probably almost 80% of our investment in year one. Well, that's a pretty powerful payback. Well, where we want to go with that next is let's talk about something called a cost segregation study. Cost segregation studies relate to new building construction or new building renovations. Buildings by Internal Revenue Code are defaulted to being depreciated over 39 years. That's a really long payback for a very significant investment. That could be your customer's investment, or that could be yours. So your financing's probably not 39 years, so you're paying for this building before you get to write it off for tax purposes. Well, a cost segregation study is an engineer-supported study that allows us to go in and take a look at the cost of that building and say, are there any elements of that building that really are not part of the building but are really there to support the underlying machinery and equipment, maybe portable office partitions, landscaping, things that by Internal Revenue Code are allowable to be depreciated over a shorter time frame. The engineer will come in, again, it needs to be someone independent that puts a study together for you, and they will allocate those costs and say, well, maybe out of the $3 million price tag on this building, we can identify $1 million that's going to qualify for a much shorter depreciable life, maybe the 5-year, maybe the 7-year. Well, now that we've got those costs into those lower buckets, oh yeah, now we can use the Section 179 or the bonus depreciation, and we've now accelerated something that otherwise would have taken us 39 years to depreciate to getting a large chunk of that in year one. So now we've coupled up the accelerated depreciation with the cost segregation study to get a very powerful deduction. The study is also, because it's done by someone independent, provides an excellent audit defense. It's based on engineering principles. It's not something we've just, kind of haphazardly allocated of our purchase price. And, it's something that we can really kind of hang our hat on should it be questioned. Also, good news for a cost segregation study is this type of change is something called a change in accounting method. We don't need to really understand what a change in accounting method is, other than to understand that we can go back to the inception of that building and catch up on that study. So if you put the building in play, or your customer did in 2010, and they didn't do a cost segregation study, one can be done today, and all the depreciation deductions that were foregone in that period can be currently deducted. Well, based on our thought that tax reform is going to drive tax rates down in the future, we may want to capture those deductions before that happens, because that will maximize their value. Let's go forward with a couple of other fixed asset items. Next is something called the fixed asset review. For many years, the IRS debated regulations on how are we going to enforce when a company is allowed to charge something off currently as repairs and maintenance versus when they have to capitalize and depreciate an item. And most of this revolved around buildings. In the past, your depreciation schedules usually had one line item that said building, $1 million, put it in place in 1995. So as we went down the road 15 years and we had to replace the furnace, and the cost of the furnace was $20,000, that was certainly immaterial to the cost, the original cost, and the current fair market value of the building as a whole. So we would write that whole $20,000 off as a current year repairs and maintenance. Well, these regulations, when they went into effect in January of 2014, said no, A building is not just one unit of property. It is made up of several units of property. And the HVAC system is one of those. The roof is another. Any elevators are another. So that if you replace just that one element, you have replaced the whole asset. That is material to the whole, so you have to capitalize that. So your $20,000 deduction now has to be spread over 39 years. Bad news to the taxpayer. What is good news, though, is if you can identify the undepreciated cost of the replaced item, the old furnace in this example, you can write the rest of that cost off at this time. Well, most of us don't have that. We don't know what that allocation was when we put that building in place back in time. Well, now, with a cost segregation study, you're going to have that breakdown as you move into the future to take advantage of that write-off. If you do the retroactive cost segregation study, you can identify those costs of assets that have already been taken out of place and fully depreciate them. So the fixed asset review is another opportunity to couple up with these other provisions. Last but not least is back to our friend the Section 179D deduction, now looking at it from the building owner standpoint. So after we go through the cost segregation study and we move assets to the 5- and 7-year class and we take deductions for them, there is going to be an element of the building that still is part of the structure, and tax code is going to say depreciate over 39 years. Well, if we qualify under those energy standards and get that $1.80 a square foot deduction, we now take another chunk out of that 39-year property and deduct it in year 1. In the case of a building owner, as opposed to the designer, we again can go back in time to capture this deduction as far back as 2006 when this provision was put into play. So let's kind of tie that all together, and let's give the example of a $2 million building that was put in place. We do a cost segregation study. It identifies $1 million of items eligible for accelerated depreciation. So as we said before, we depreciate almost $800,000 of that $100,000. It's a 100,000 square foot building. It qualifies under Section 179D. We deduct another $180,000 in year 1, and then the remainder, a little about $900,000 or less, we're going to take over that 39-year period. But we've now taken almost $1 million or more of deduction in year 1 versus taking $2 million equally over 39 years. That's a great story, I think, to tell to your customer who you're designing that building for and say, if you can get $1 million in tax deductions and you're in a 40% tax break, you just put $400,000 in your pocket to help pay for this project. Yeah, it's a timing difference, but based on the time value of money and the fact that we expect tax rates to go down in the future, it's a pretty powerful tax savings. So that's the story on the fixed asset potential savings. A couple more items, and I'm going to go through these pretty quickly. Something called the IC DISC is something that's applicable. Should you be looking at being involved in any foreign projects, foreign construction projects? You don't have to necessarily have boots on the ground and be going to that foreign country to do the work. It can be design work that you're doing here from your domestic office. And I think sometimes when we say foreign, we start thinking Europe, Asia, what have you, but it could be a project in Canada. It could be a project in Mexico and the Caribbean. If you're, have connections in those places, these would be the type of contracts that would qualify for this provision. What ICDISC stands for is something called Interest Charge Domestic International Sales Corporation, and I'm sure that didn't tell you any more than the term ICDISC. But really what it is a provision to have your profits from foreign projects taxed at a much lower tax rate than the current ordinary income tax rates. It's been around since 1984, but it really didn't become attractive until 2004 when there was a change in the tax law that said that dividend payments are taxed at the capital gain rates. Now, you may be familiar from your own personal investments. You may have mutual funds or stock holdings where you're getting dividend payments, and you may know that they get taxed at a much lower rate than something like your wage or your business income. Well, that's the concept behind the IC DISC. The IC DISC is a separate legal entity, but it doesn't pay any taxes. It's a tax-exempt entity. What it does do is receives commissions from the operating company based on the foreign revenue, typically 4% of that revenue, and it in turn pays that commission out to the owners. So we get a deduction in the operating entity at as high as almost 40%, and we pay tax on it at the individual level at sometimes at 20% or even lower at the capital gains rates. Now, you need probably about $1 million in foreign revenue to make this worthwhile, but if it is something that you are looking to step out and do some foreign projects, I would suggest you take a little bit deeper dive into this. Also make a suggestion that, again, we keep our eye on tax reform, because one of the provisions that's been talked about at times by the Trump administration is to actually exempt all foreign income from tax. Well, if that's the case, the IC DISC won't be needed. But until that happens, it's certainly something to consider. The next slide, and we'll share these slides with you later, goes through a little bit of the detail of how the calculation is done, but I think in the interest of time, we'll go ahead and skip over that and move on to the next area. Olivia spoke in her intro for us that our firm is putting a very deep emphasis on state and local taxes. This one maybe doesn't come with as much of a positive spin as some of the others we talked about today, but it's certainly something to be aware of. Our state governments and even some of our local governments are facing an awful lot of budgetary pressures right now, and they're getting very, very aggressive in seeking out new revenue sources. And one place they're looking for is the out-of-state company. So if you are doing design projects outside of your home state, or you have offices in multi-states, I think this is something that deserves a little bit of your attention, because it is a rapidly changing area. The cost of compliance is complex. The penalties for non-compliance can be very costly. And as I said, it's something to keep your eye on, because it's, I think, even a little bit more complex than federal taxes, because each state has the independence to initiate a variety of different taxes, and there's little uniformity from state to state. So we're not just talking about corporate and individual income taxes. We're talking about many, many other types of taxes. Some of them are purely on your gross receipts, whether you make money or not. You could be subject to sales taxes in the other state, even if you're exempt in your own state. So it's something that I would recommend you take a look at, and there's some services or some activities that you can utilize to get a handle on that. One of them is something called a nexus study, another one is something called an apportionment review. That's really just identifying, do you have a presence and a liability in another state, and if you do, are you allocating your income in the most efficient manner? There's a number of other things that can be done. If you have property in another state and you think you're being overcharged for the real estate taxes, there's the ability to appeal that. If you're looking to move into another state, before you do that, take a look. There may be incentives, both for putting real estate or creating jobs in another state. And if you are in those other states and have been there and you haven't been filing, a lot of states will allow you, if you come through, if you voluntarily come clean on that, to do what's called a voluntary disclosure agreement, which still charges you the back taxes, but it oftentimes will eliminate the penalties and maybe even some of the interest associated with that. So as we move on that, we come to our last polling question, and something that is getting a lot of play in the professional services world is something called market-based sourcing. So our last poll question is, have any of you run into this? Do you have any awareness of market-based sourcing?
100% no.
Okay, so the answer, everyone is unaware of market-based sourcing, so hopefully we can give you a little bit of an overview of what this is all about. And again, this pertains to, are you doing any design work in another state, outside your home state, outside of Pennsylvania? Traditionally, the way that revenue has been allocated between states was on something called the cost of performance method. So even if you're designing a building, you're sitting in your office in Pennsylvania and you're designing a building in Maryland or New Jersey, as long as the majority of the work was done in your office under cost of performance, that revenue would be allocated to Pennsylvania because that's where the work was done. Well, the states have looked at that and said, we're missing out on income. The benefit from this project is within our state, but no one's paying tax on that effort. So a lot of states, Pennsylvania included, have flipped away from the cost of performance method to the market-based method, which says regardless of where the work is done, it's the state where the benefit is received, where the building of the bridge or what have you is built, that is going to receive the tax on that. The problem is the application has not been universal amongst the states. To date, a little over 20 states have adopted market-based sourcing, and that's a growing number, but that still leaves an awful lot of states that are following the old method. So think about if your state, and if you're in Pennsylvania, it's not, but if Pennsylvania were a cost of performance state and your project is in Maryland and Maryland is a market-based state, both states are going to make claim to that revenue and you're going to be subject to double taxation. Now on the flip side, if your state is market-based and the project is in a state that's cost of performance, you theoretically could avoid taxation on that. So it's both it can be both a blessing or a curse, I suppose. You just have to know those rules, and we have to stay on top of the ever-changing nature of those rules. North Carolina, I believe, was one of the latest states to adopt the market-based sourcing rules. So again, we won't get into all the detail on which state has it, which state does not. Just be aware that if you are doing any work on projects outside your home state, take a look at these rules and don't get caught with the tax liability that comes as a surprise to you. The last section we're going to go through pretty quickly is credits and other incentives. At the federal level, there is a credit called the Work Opportunity Tax Credit, which can be up to $9,600 per person through 2019 for hiring folks that fall in specific classes. Those classes are listed on your screen. Some of the most frequent ones we see is the hiring of veterans, especially disabled veterans, hiring folks that have been on the unemployment rolls for as much as 26 or more weeks, and a number of other categories. You do have to be very proactive to gain these credits. Your paperwork has to be submitted within 28 days of the hire date. But just be aware that if you hire anyone who falls in these categories, there may be a nice tax savings out there for you. A couple of other credits that again, probably are going to be something more applicable to your client, but something that's good news to bring up to them, help you get that work. The Historic Preservation Tax Credit can be up to 20% for the cost of renovating a certified historic structure. It can be 10% for some certain other structures built before 1936. So if you get into those type of projects, you may want to have some discussion on the credit. An even broader credit is something called the New Markets Tax Credit, a very complex program, but it's a credit for helping to revitalize identified low-income communities, typically within our cities. That can be a very lucrative credit for the investors, up to 39% of the cost. As well as at the state level, there are many programs available, whether that's job creation, whether that's technology expansion, whether that's moving into depressed zones. My suggestion there would be, before you take much of any action, just do a little research or have someone help you out to determine is there some benefit to you, and maybe that helps make your decisions on where you might be expanding to. So that was a lot of information packed into an hour. I hope I didn't lose you or confuse you with some of those items. I'm happy to follow up with any of you on any questions you may have or even have a direct conversation. Hopefully you're able to take away some new information today and identify some opportunities to save some additional taxes. So with that, I don't know, Kaylee, if we have any questions. Doesn't look like we have any now, but we will follow up and get everybody the slide deck. And certainly, please feel free to correspond back to us with any questions you might have. And with that, I think we'll flip it back to Olivia if you have any final words.
No final words. Thank you so much, Tom, for sharing your expertise with us today, and we thank all of you for joining us on this webinar today. We look forward to the next Stand on Us webinar. That's going to be scheduled for Wednesday, July 19th at 3 p.m. The topic is the business of architecture, and registration is now open at aiapa.org. Thank you again for joining us, and have a great day.